Hello and a very warm welcome. You're watching Reset India with your host Kriti Mishra. Our show focuses on all the key areas where resetting, revamping or restructuring is required for boosting India's growth prospects. And today we'll analyse the impact of budget proposals on the banking sector. The Union Budget has proposed to recapitalize public sector banks for 20,000 crore rupees and to set up a bad bank to remove toxic assets. Maintaining the health of the banking sector remains a policy priority, and preservation of the stability of the financial system is an overarching goal. And to discuss the way forward, I'm joined by Dr. Ahmed, former Executive Director, Punjab and Sindh Bank, Mr. A.S. Bhal, former Principal Economic Advisor to Government of India, and Dr. A.K. Sharan, Professor, AJNIFM. Welcome to Rajya Sabha Television, all of you. And before we actually begin our discussion, here are a few insights for our viewers. So the government has proposed to increase foreign direct investment limit in the insurance sector to 74% to attract overseas players. Finance Minister Nirmala Sitharaman announced that 2 public sector banks and a general insurance company are expected to be disinvested this year. This will be in addition to the disinvestment of the IDBI Bank. The government will introduce a bill to set up a development finance institution, providing 20,000 crore to launch the National Asset Monetization Pipeline to fund new infra projects. DFI will also act as a provider, enabler and catalyst for infrastructure financing. And now let's go back to our distinguished guests. Dr. Ahmed, coming to you first. COVID-19 was this exogenous shock that disrupted economies worldwide. Every sector took a beating and banking sector was no exception. There are fears of NPAs. Now, tell me the impact of the budget proposals in reforming the banking sector, according to you, sir.
Even before COVID-19 impact, the economy has been slowed down. But as far as the gross NPAs of the banks are concerned, there was improvement by September 2020. But because of the COVID, not only the India, the entire world economy has been affected, and it has hit hardly the Indian economy also, because the government has taken a conscious decision to implement a lockdown, because more than the livelihood, life is important. So this has an impact on the different sectors of the economy, most prominently on the real estate, hospitality, tourism, aviation industries, and indirectly or directly it has affected the personal incomes of the entire population. So it is going to have the impact on the asset quality of the banking industry. As per the financial stability report of the Reserve Bank of India also, the gross NPA ratio, which was at 7.5%, at the baseline level itself, it may be around 13.5 for the entire scheduled commercial banks as a whole. And for the public sector banks, it may be much more than that, around 15.5 to 16%. If it is severe stress is applied, the NPA level ratio may be much more, excluding the written off amounts which were done in the last 2-3 years. Coming to the budget proposals, before coming to the financial things, I should appreciate the government for allocating a maximum 137% increase in the healthcare, keeping the COVID-19 in view. That is most important step expected by the public, and it has been taken care by the budget. Coming to the financial things, most important are, one is creation of asset reconstruction company and asset management company. The second one is the recapitalization, as you said, 20,000 crores, and announcement of privatization of 2 banks and the creation of development financial institution. First, I will start with the creation of development financial institutions. It was very much in need for the last few years, because after the dismantling of these financial institutions, the entire burden of financing the infra was taken by the commercial banks, whether they were having the necessary expert or not. And particularly in 2007 and 2008 and 2009, the economy was booming and the GDP was about 7 to 8%. And the entrepreneurs are very, very ambitious to invest, and the promoters have diversified their activities, even though they are unrelated things. And the banks were also financing, and the credit growth was about 20+%. And when the NPS were actually seeds of NPAs were sown in that period, and they came to the light after 2015 after the special dispensations of the restructuring were removed by the Reserve Bank of India. So the NPS has had that expertise was not there. Not only that, now after COVID, the push to the infra is very much required.
Yes.
And infra finance is going to increase in the coming next year and also the coming 4 to 5 years, as government announced it, extending its 111 lakh core infrastructure pipeline up to 2025. The need of the development financial institutions is very, very important, and it is essential. But most important is how the funds will be mobilized, how these development financial institutions will raise the cheaper funds. That is most important, that we have to see in the coming days. Coming to the creation of ARC and the bad bank,
yes, sir.
It has been in the discussion for the last few years, 3 to 4 years, and it has a right decision taken, because by creating a bad bank, the gross NPA from all commercial banks or different lenders can be transferred to a one bank. There the aggregation of the exposures will happen, and the bank will be in a better position to do the better discovery and also to dispose and find the resolutions with the ARCs or the interested investors.
All right, sir. You mentioned about bad banks.
Most important
yes,
is
sir.
In the budget, there is no design or structure of the bad bank was announced. That is much more important than the creation of the bad bank, because bad bank is not a panacea for the NPA.
Yes.
It is the transfer of NPAs from the banks for aggregation and for better price discovery and disposal at an early period or in a short period.
All right, let me take that to Mr. Bhal. Mr. Bhal, we're talking about bad banks. Now, Finance Minister Nirmala Sitharaman announced this during her budget speech. Of course, she did not use this specific term, and the model that would be adopted would be asset reconstruction model or of that company. But help us understand the concept of a bad bank. What is a bad bank?
The finance minister has responded to a long-felt need of the banking sector. You know, the banking sector in India has been sort of suffering with NPAs for some time, and that was affecting the credit flow to the good sectors also. You know, the bankers were being wary of lending even on commercial grounds to good projects because they were bothered about the non-performing assets. So what the bad bank does is it removes the NPAs, non-performing assets, from the balance sheet of the banks and takes it to a designated asset reconstruction company who's much better equipped to handle it. So what this does is it unleashes the sort of create optimism in the regular commercial banks, who are then free to go ahead and lend on commercial grounds to good and viable projects. You know, there's a term in economics which says bad money drives good money out of circulation. I mean, just as a analog, I'll say if there's too much bad assets with the banks, all the managers will be very wary of lending to the even genuine sector. So by hiving off these toxic assets to a specific company which is more equipped to handle it, what we are doing is we are unleashing the creative energies of a regular bank to lend to good projects on commercial terms. Thank you.
All right, I'd like to understand further. Dr. Sharan, what are the global parallels to taking the bad bank route in cleaning the NPAs? How has been the experience, and what can India learn from them?
Well, the global experience has been quite ahead of us, and the things that we translated in the Indian economy, whether it is asset reconstruction company or the latest concept that we are discussing, the Western countries have already experimented that, and particularly USA has been quite ahead, though they also had the subprime kind of a crisis, which was the overstretched valuation, which the Indian banks also are. Now, when we talk about the European economies or the advanced economies where the banking system may not have in many cases the burden of the priority sector lending and all kinds of things, the arrangements in the banking there would be very different, and the role of the central bank also is different. Particularly Germany and other countries, you find the role of the central bank is very different. However, in the Indian economy, where we have had the legacy even earlier up to 69 and the later years also of the Bank of England model, where our lending, where our other banking activities are quite secured and they are highly securitized, in these kinds of situations and the way the public sector banks have been conducting their businesses quite recently in the past, it is very much the need of the hour that the hand-holding by the government goes for some more time, because you can't suddenly get out of the cultural background that the public sector banks have. So in the current dispensation, I believe that the hand-holding by the government requires an very much guessing the need of the hour, and also juxtaposed to the financial stability report, which came up recently in the past. The budget is quite geared up to resolve the miseries of the public sector bank. And the infusion, as I believe Mr. Farid also mentioned, that at this outset, with reference to the latest budget, the infusion of the capital for the recapitalization and also the 100% sovereign owned DFI, which is also the need of the hour, because DFIs not only contribute to the infrastructure sector, they also contribute to refinancing, which means many public sector banks would be getting bit of their resources also from the development financial institution. One point which in the Indian context is very concerning, if I won't use the term alarming, is that the quality of the assets definitely need to improve. And with whatever arrangements earlier we experimented with the ARC, that is the Asset Reconstruction Company, the improvement in the quality of the assets, which once have become kind of compromised assets, is not that easy. And particularly in the wake of COVID, I don't think it's going to be an easy job, at least for a minimum of 2 years from now. Last point which I would want to say here, for which the banking sector will have to kind of take a turnaround situation, is the spreads in the banking sector. You look to the current business scenario, you look to the deposit surge, which is all right. But if you talk about the credit, the credit offtake is not that encouraging at the moment. And if the CD ratios are not properly managed by the banks, then definitely there is going to be a case of further narrowed down spreads, which will further call for another attempt of the government for infusing funds to improve the regulatory requirements. And therefore, the present budget, if you talk about the budget, has taken the right step by infusing capital in the banking sector. However, as I said in the beginning, this hand-holding period has to go for a longer duration, and maybe the next quarter, the next quarter, or the next budget will require a similar approach by the government to further take care of the public sector.
But sir, experts have also voiced concern on the sustainability of this hand-holding on capital infusion. What is your take?
As far as the hand-holding is concerned, as I said, there was no specific design or structure was announced. The government can adopt different structures. But first of all, according to my view, the asset reconstruction company which is being proposed, it should not be a permanent nature. It should be for a period of 8 to 10 years. It should take over the gross NPAs of all the banks up to a cutoff date of say March 2022, and this over a threshold limit of some 50 crores or 100 crores, so that the large borrowers who are contributing to the stress assets above 50% will be transferred from the regular bank's balance sheet to bad bank or the ARC, so that the banks can concentrate on the fresh lending. As Dr. Sharan said, because the CD ratios are coming down, the credit growth was a 20% 7-8 years back. Now it has come down to the single digit, that 2 to 3%. So unless until the banks channelize the mobilized deposits, they cannot increase the profits and spread. So the banks can concentrate. In fact, the banks may not be expertise in recovery. So this bad bank with the experts as their professional teams can focus on the recovery of the bad debts, and they can help. But this structure should be for a temporary period. It need not have the capital in a big considerable amount, because if they follow the security receipts concept with certain dispensations from the Reserve Bank of India, in presently there is a 1585 ratio whenever an ARC take over a NPA. If such dispensions are given and issue of the SRs are with zero cash margin and the government interferes and gives some guarantee, the banks also can treat them as an investment in SRCs as a zero risk weighted, so that it will help to the banks for conserving the capital and focusing on the lending to the new borrowers, because in the coming 3 to 4 years the economy should be revived. It requires a lot of investments and also a lot of support from the commercial banks.
Mr. Bhal, I could see that you wanted to make a point. Please go ahead, sir.
Not me.
Mr. Bhal, I could see that you wanted to make a point on credit takeoff. Go ahead, sir.
Nothing specific. Mr. Ahmed has said whatever is to be said. No, thank you.
All right, going ahead and talking about the other major announcement that Finance Minister made, and that was about privatization of 2 public sector banks. What would that mean for the banking landscape in India? Mr. Bhal?
Well, that's a fairly bold decision, but it's an idea whose time has come. Going by the international experience in banks, a certain size and scale is required to do certain things. So after a lot of deliberations with the banking sector, with the other stakeholders, the government has come down to this conclusion that some of these big banks should be privatized. And it's a global phenomenon. It's only in India that such a heavy deployment of public sector banks is there for credit. All over the world, it's mainly the private sector banks which is best in a regulated manner, which is best suited to handle the risk and then deploy credit is being done. So what the government is doing is responding to an idea whose time has come. Of course, it will take some legislative pushing through and stakeholder consultation and consensus, but it's a really good idea and I would strongly recommend it as an idea whose time has come. Thank you.
Dr. Sharan, do you agree?
Particularly if I am supposed to respond to Mr. Bhal's narrative, I would have a slightly different view on this. The idea is very good that we should have some more privatization efforts. We started a long time back in the mid-90s something when we were very aggressive about the disinvestments and privatizations. Privatization of the public sector banks is a good idea, but possibly the timing is not correct. Because in the financial stability report, when we were perusing on the same channel sometimes back and on other occasions, we saw that when it comes to the regulatory requirement, the private sector banks, they are not in good shape. They have earlier also borrowed money to meet the regulatory requirements. So we never know whether around this time, such kind of privatization endeavor or attempt for 2 more banks will land the bank in what kind of a situation. And it also is quite possible that they become free to some kind of a merger or takeover with unsolicited kind of private sector banks which are already there and not in very good condition. So I would find that the implications of the privatization, they are well known to everybody, to the analysts, to the economists. But the timing for privatization, I think this should be done with some break, like immediately it may not be solicited. Because what the government has been looking forward to is some kind of what we call a denationalization, which happened in UK also, which happened, the cycle is complete. That you did nationalization and you have had the fruits of nationalization. Now you find that it has become kind of a, your social responsibility has kind of ended, and therefore you would want these to be handled by more specialized institutions. But then while you do it, and the kind of banking scenario which we have as on the date, I personally feel that this kind of an attempt to denationalize or privatize the public sector banks would be held back for some more period, and till and until we have a complete recovery from the COVID kind of a shock, may not be the right timing for many new things to happen, particularly the banking sector, because the banking sector has lots of stakes, not only of the direct stakeholder, but the entire depositors and all kinds of stakeholders are there. So therefore, to keep the public sentiments in place, to keep the employees' sentiments in place, because privatization happens to two banks, the other banks also get quite nervous that maybe next time it is their turn, kind of a thing. And from some 19, 18 to 10, and now 10 to 8. Now, if it goes like this, possibly immediately it may not be a very good sign. Though I agree in principle that government should not have all the reasons to be in business where the private sector is more expert, yes. But then possibly this is not the right time for privatization.
Let me take that to Mr. Ahmed. Mr. Ahmed, how would you respond to the concerns of Dr. Sharan?
According to me, it is more integrity and autonomy of the functioning of the banks is important rather than the ownership, whether it is a private or public sector. That is my point. But as Mr. Sharan said, we should have waited for some more time, because the government of India has started these reforms of governance and other things of the public sector banks, and 3 times consolidation has happened. First time with associate banks with the State Bank of India, then Bank of Baroda, Dina Bank and Vijaya Bank, and last year 10 banks into 4 bigger banks. We have not seen the result or impact of these consolidations, not yet, because they are in the initial stages of the consolidation. The very objective of consolidation is to make them more competitive, they make them to more efficient and enjoy these economies of scale, and also to invest in the technology and compete with the private sector banks so as to improve their efficiency. So they should have waited for some time, and then they should have taken the time. No doubt, privatization, whoever supports, they said that the efficiency will be improved, income per employee will be improved, this will be there. But even after that, if you see the history from 1969 to till now, after first nationalization and second nationalizations, the public sector banking has contributed a lot to the development of Indian economy, and also to reach to the nook and corner of the country. Very recently means in the last decade, the Janadhan Yojana is successful just because of the public sector banks. However, because as Mr. Sharan said, a cycle has been completed, fruits has been enjoyed. Yes, if the necessity is there to privatize the banks, the government should have waited some more time, seen the fruits of the consolidation. If they feel that it is necessary to privatize, then they should have taken a decision. That is my opinion.
All right, going ahead, we'll have to get a clarity on that as to when this disinvestment is going to happen. But before we conclude our show, closing comments from all my guests. Mr. Bhal, banking reforms and way ahead.
Yeah, so on this, I'd like to respond, this slight, uncertainty about when to go in for privatization, There are a huge number of public sector banks. I mean, right now, as someone was saying, 19, 20, now 9, 10. So if 2 banks are privatized, and the rest of the banks, public sector banks, do the work that's assigned to, I think it's a fair apportioning of risks and rewards. In economics, we have a term, in management, we have a term called horses for courses.
Yes.
I mean, now we need, in this global scenario, when India is sort of plugging into the global value chains, we need big private sector banks, very nimble-footed, who can go ahead and without the strong worry of those VCs and vigilance commissioners and what have you, go ahead and do lending on commercial terms. Public sector banks are great. I was myself a state bank. A lot of investment went to very concerned sectors, but the private sector banks is an idea whose time has come. We cannot be sort of attached to the earlier regime and stick on to the slow and trudging path of economic transformation. This current regime sort of is more bold and is going ahead and taking a more stronger action and sort of embracing the market forces with, of course, regulatory oversight in a very particular way. That's all I would like to submit. Otherwise, there are very valid comments made by Mr. Sharan and Mr. Ahmed. Thank you.
All right. On that note, we'll have to wait and watch the impact of these proposals on making our banking sector more robust. Thank you so much for joining us. So that's all we had for you in Reset India. Thanks for watching and stay tuned to Rajya Sabha TV.